Hi, welcome to Accounting Discussions. I'm your host, Joss Mabry. Today, on our show, we're discussing several accounting standards, including AASB 112, income taxes, 136, impairment of assets, 16, leases. We'll discuss the objectives and effects and the difference of opinions in the different positions in the company. On today's show, from B&J Accounting, we have Stephen Owens.
Hi Joss, thanks for having me on the show today.
And CEO from Helmet & Co, we have Josh Bajanic.
Hi Joss, pleasure to be here.
So Josh, let's look at AASB 112 income taxes. Why are deferred tax assets useful to recognise in the balance sheet?
Well Joss, essentially deferred tax assets are useful because if the company does have a loss, the tax proportion of that can be carried forward as a deferred tax asset. Viewers will understand this as being beneficial, as if we did record the entire tax loss, it would hurt shareholders under.
Do you see any issues that can arise from this?
I don't believe there are any issues, Joss. We are entitled to recognise it as an asset and it will offset the taxable profit in the future.
Here's Stephen, an accountant, to give his view on this.
Well Joss, in my opinion, deferred tax assets could mislead shareholders into thinking assets are overstated.
How so?
Well Joss, deferred tax assets can only be used if the company actually earns a profit in future periods. Some companies can never recover from bad periods and will never again realise a profit. This means the deferred tax asset will never be used as the asset, and subsequent derecognition of this deferred tax asset, when it is no longer probable to be realised, will have an impact on net assets in the balance sheet.
So we have to interrupt you there for a second, Steve. Look, I understand where you are coming from. However, as a business, we are entitled to recognise that asset, pending the recognition criteria, of course. There is no misrepresentation here. Shareholders, stakeholders, they do understand this.
Well Josh, what about shareholders and creditors who just look at net assets in these balance sheets? They're not going to go over it line by line.
Look, Steve, as far as a business is concerned, the disclosure is there. We are entitled to recognise this.
I'm going to have to stop you there. We're going to go to a break. This is really interesting stuff. Hopefully these two will still be here when we get back. Welcome back. Moving on from AASB 112, let's move on to have a look at AASB 136, impairment of assets. I've been told that it's all very similar. Josh, what are your views on this?
Well, Joss, you're 100% correct with that analogy. Once a market value decreases under the cost model, we impair the asset. Under the revaluation model, if the underlying asset decreases in value, respected to the market, we will adjust that as well. Essentially, we price the price as the price should be.
Oh, I see. Stephen, what is your opinion on this?
Well Josh, that's not entirely true. Impairment of assets under either the cost or evaluation model do have subjective elements. Professional judgment is used in finding the market value, and assumptions are often made as items are rarely in identical condition. This could lead to different carrying amounts for assets, even if they are virtually identical. For example, Josh, when considering value in use used in the revaluation model, we need to estimate the future cash flows and discount rates. Every accountant will estimate different amounts, leading to variations in impairments between companies. And Josh, the price you can receive is only realisable when you actually sell an asset. Otherwise, it is just an estimate.
I understand where you're coming from here, Steve, but as a manager, we rely on professionals and their professional judgment, much like yourself as an accountant. We go off that judgment and we value the asset.
I think we'll take a short break there to cool down.
Go.
Welcome back. We've just talked about AASB 112 and AASB 136. Now we're moving on to AASB 17 to 16. Josh, from the move from AASB 17 to 16 regarding leases, what are your thoughts on this?
Well, Joss, I'm not in favour of this change. If it's not broke, don't fix it. In effect, what the business has to do is we just have to reorganize all our assets and liabilities, which creates more work for the accountants like yourself, Steve. It costs us more money, and in the end, the bottom line is everything remains the same. There's not really much that is actually different.
So it's just more work for no reason. Stephen, your thoughts?
Well, Joss, there have been many cases where non-recognition has severely misrepresented the company's position. We can look at the Lehman Brothers, for example, to see how non-recognition can cause problems, like a global financial crisis. While most businesses will adapt to the new standard, I think Josh is more interested in how he can show the company's financial position to get his bonus, which this standard allows him to do.
Look, Steve, I understand accountants don't fully understand how the business works. After all, they are just number crunchers. There is a reason why CEOs do get paid to make big decisions.
Well, Josh, it very much sounds like you may end up in jail.
Well, Stephen, as the saying goes, corporate bail never fails.
I think we'll stop it right there. As this is all we have time for. Thanks for tuning into this episode of Accounting Discussions, where we bring the cutting edge of accounting to your living room. See you next week, where we discuss about hypothetical future value accounting, where we have been told you can add $1 zillion to your bottom line. Thanks to our guests, Stephen Owens and Josh Bajanic. I'm your host, Joss Mabry, and as always, stay classy, San Diego.